Hey guys, it's Sash, and today I want to talk about a company that I am very interested in, and that company is Pinterest. This one is very interesting for a few different reasons. First off, Pinterest has taken a massive hit recently, several big punches to the face, and the share price is now trading at about $45 as I'm recording this video. This is lower than it was at this time last year. The trajectory is not looking good. Pinterest shares have been on a decline for pretty much the entirety of this year. And Pinterest has never turned a profit. Number of active users in the US, their biggest market, is falling. And yet, I am very excited by this stock. At the point when I'm recording this video, I hold a relatively small position in Pinterest, but I plan to increase it significantly in the next few days. So why would you invest in a loss-making company that seems to be declining and heading for the dumpster? Well, let's talk about it. For those who don't know, Pinterest is a relatively unique, quite unusual sort of combination of a search engine and a social media platform. It is a visual way to find information, a way to then store that information so that you can always go and reference and find it again, and a way of sharing that information with others. Because of its unique properties, Pinterest has very unusual demographics. The platform is very popular with women, and it strongly appeals to older cohorts, higher profitability cohorts, although this year Pinterest has managed to actually up its game and increase a growing number of younger users as well. And the common reference is that Pinterest is the third biggest search engine in the US. I say it sometimes after Google and YouTube. And I am not going to get into a debate as to how exactly you define that, etc. But there is a lot of really interesting stuff about how this platform works. So I decided to go and look a little deeper at Pinterest, and that's what I spent the last few days doing, and here is my take. Pinterest as a platform has been growing in terms of users for some time. In the last quarterly report for Q2, Pinterest had 454 million active users, with 91 million of those in the United States. And this is the bit that investors did not like. A year ago, Pinterest had 96 million users in the United States, and the number has since then fallen by 5 million. And if you look at the earnings presentation, there is a graph of what this chart looks like for recent quarters. That number of US users is flat, and it dropped in Q2. Not a good sign. Even the total annual growth rate of all the users is only 9%. And so the investing world took a look at this, and they didn't look any deeper, it seems. They looked skin deep and declared the platform to be dead. A massive sell-off happened because, after all, growth in the number of users is the only metric that matters when you value a company like Facebook, Twitter, or, Pinterest. But here is a thought. The total population of the United States is 330 million people, and about 11% of that is under 18. So from a usage and commercial sort of point of view, those under 18 people are probably not the target market. So you have about 294 million people in the pool, if you like, and you have 91 million of them captured as active users. That's 31%. So the fact is, Pinterest has probably reached a point of saturation. I mean, it can grow from here, it can capture a vastly higher number, but a third is already incredibly high. So this is what's actually happening here. The jump down from 98 million active users in Q1 to 91 million users in Q2, and the drop compared to last year are factors that I think are primarily based on exogenous happenings. Things that are not to do with whether the company is growing or not, things to do with what's happening in the world. Last year, the first wave of COVID was happening big time in Q2, and everyone was sat at home, using things like Pinterest. This year, Q2 was very different. In the winter, people tend to sit at home as well with higher internet usage and all of that kind of stuff. And all things being equal, I would fully expect the number of active users for Pinterest as a platform to drop naturally in Q2 and Q3 if the total number of users was staying flat. But here's the bit that I think people are really missing. Facebook. Let's look at Facebook. They have 300 million active users in the US. So pretty much everyone who can read has an account, it seems, and even people who can't. But a few days ago, Facebook released their quarterly results, and here is their daily active user chart. Look at that dark blue bit at the bottom. That's the US number of active users. And it's been completely flat for the last 2 years as well. And check this out. Facebook's Q2 this year also had less active users than Q2 last year. How surprising. But now look at the revenue per user numbers. Facebook makes $52 per user in the US and $10 on average across the world per quarter. These are really strong numbers. Now, obviously, I am not comparing Pinterest to Facebook directly. I understand that the two are very different. Facebook users will be far more sticky and use the platform with higher frequency. I do get that, but Facebook has been growing their revenue per user very consistently year after year after year. Just 2 years ago, the US users of Facebook were earning $34 and the global average was $7.26. But jump back to 7 years ago to Q3 2014, and in the annual SEC filing, Facebook has a quarterly revenue of about $1.5 billion from US customers who at that time were 206 million active users strong. So that's $7.35 per active user in the US, 7 times less than what they are earning today. Pinterest is very early on in their journey. They only started making profits in the last few months. They are many, many years behind Facebook in the sophistication of their revenue streams, in the sophistication of their relationships with advertisers, in the sophistication of their advertising platform. And their average revenue per user in the US at the moment is $5.08, with the global average being just $1.32. Sure, they are not Facebook, but this is a super visual discovery platform with high net worth target audience, and the revenues here have a long way to go in terms of growth. You can also see that the growth in revenue over the past few quarters has been exceptional, and I expect that to continue over the next few quarters as well. I'll cover that in a second. And looking at the P&L, I am not going to break down all the numbers in full, but when I was looking through the results, the costs have been very consistent in how they've been declining fast in percentage terms. As the company is growing its revenue and maturing, every single one of those cost items is dropping as a proportion, and that is very normal for this stage in the company's growth. And that is exactly why they are now becoming profitable, and why the rate at which that profitability is going to grow will be not linearly proportional to the rate at which the revenue is going to grow. And this is the critical bit. So after I spent a few days studying Pinterest, I went and made a relatively basic DCF model, and here it is. Let's go through it. I am projecting for 5 years plus 1 quarter, Q4 for this year. Q3 results are already in. They are going to be announced on Thursday, November the 4th, in a few days. So I am going to be ignoring them here for the purpose of this DCF model. I am projecting a 58% rate of growth for Q4, which is much lower than all of the recent quarters. And that gives me $1.1 billion. And then I have an annual revenue of $4.5 billion in 2022. That, according to my maths, is about 55% up from what it will be this year. And I think that is a reasonable assumption. Even though it's high, it is very reasonable given that it is a massive drop from the rate at which the revenue is growing right now as of the last quarter that we have data available for. So I am pretty happy with that. I then continue dropping that rate of growth every single year afterwards. I actually don't think it will drop. It might stay flat. It might even increase at some points. But let's be conservative here because of the optics, let's just give it a slightly conservative edge. So I have it declined to 50% growth in 2023, all the way down to 32% in 2026. And some people might say, well, there's no way it will continue growing. But in my opinion, the optics of where the company is right now, the stage they're at, and the industry they're at, I think that is conservative. Remember, it was running at 125% growth last quarter. And then I have all of the costs projected, and I've kept these super simple. I start with the costs at a relatively similar level to where they are today. And I am then taking them and projecting forwards by tapering them slowly as a percentage of the revenue line over time. I taper them much more slowly than they have recently been coming down. So they've been coming down very sharply, and I'm sort of saying, okay, well, they'll continue going down, but not quite as fast. And it's pretty much as simple as that. Then I have the same sort of thing for depreciation, net working capital movements, capital expenditure, and you can see here that I'm only showing a $461 million profit next year, but that then grows all the way to $5 billion by 2026. And some people looking at that revenue projection will say, hey, that is bonkers. The revenue in 2026 is 4 times what it is in 2022. But I just told you how I got there, and to me, that actually makes a whole lot of sense given the direction and the business model. So then I do the same thing as I always do for working out the price target. I stick on a 10% annual discount rate, I set the perpetual growth rate to 5% here, and a 20 times multiple for EBITDA in 2026. I probably could have extended this model by at least a year, maybe a few years, because the rate of growth would mean that my target price would be higher if I modeled to 2027 or beyond, but let's just leave things at this. We can take that next quarter or the quarter after. By the way, one unusual thing with Pinterest that you might be interested in is the fact that they have no debt. They have almost no liabilities. For a company at this stage of growth, that is really rare. And they also have 2.6 billion in cash and short-term investments, so that is a super healthy balance sheet for a company like them. Here on the right, I've taken the total number of shares, including all outstanding options and warrants that will become shares in the future, and that's what that 644 million shares number is. And then I have the two methods that spit out the answer. It's pretty simple. The perpetuity method gives me a target price of $69, and the EBITDA approach is $100 with that 20 times multiple. And given the very fast rate of growth all the way through the next 5 years, I would say I'm going to lean much more towards that latter number. I actually think even the latter number is probably conservative because I'm using a multiple that is much lower than the rate of growth at that point in time. I'm also only projecting for 5 years, but could be projecting for more. So I'm going to set a conservative target price of about $85 on this one. And as the price is about $45 as I'm recording, that gives me a 90% upside. And I actually think that this valuation is so conservative because I'm tapering the growth right down starting next year. And that means on that basis, I am going to be increasing my position in Pinterest. I think the valuation at the moment is disproportionately low. I will be adding to that position in the next few days, including in my man versus the market portfolio. And that's pretty much all I've got to say. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching this video. I really appreciate it. And as always, I'll see you guys later.